Hello again from Core Wealth. We are looking at the month of October 2024, what happened in markets, what's been going on around the world. Interest rates in the US had recently been reduced by about 0.5% in anticipation of inflation starting to come under control and their economy slowing slightly from an economic growth point of view. However, we've seen that inflation isn't coming down as quickly as perhaps had been anticipated, and the economy isn't really slowing as much. So that is still a concern in global markets. On the commodity side around the world, we've seen the oil price tick up in the month of October after 3 months of it reducing in price. We saw the gold price actually tick up quite strongly and go through $2,700 an ounce. This again was on the back of turmoil around the world, or concerns about turmoil in the Middle East, for example, and also what the outcome was going to be on the US election. In China, we've seen that China has been trying to stimulate their economy with a number of packages. Those are starting to show some signs of impact, and the Chinese economy is starting to pick up a little bit in growth, which in the longer term may be positive. So in South Africa, we saw our stock market come back a little bit after a good number of months of positive growth on the back of the new government of national unity. It was pretty much across the board. The only area where we saw some respite was in the resource sector, and that, as you can imagine, was on the back of the commodity price improvements that I just spoke about on the global stage. But South Africa, the medium-term budget was during the month of October. We'll talk about that in a lot more detail, but suffice to say that it showed quite a prudent government, if anything maybe a little bit too conservative, but that really in the longer term is a better view to be having of how our government manages their finances. So if we have a look at how different stock markets did around the world, you can see in this slide that for the month of October, everything was red. So developed markets down just 2%, but emerging markets down 4.4%, and you can see the rest of the markets there. European stocks down over 7%. However, if we look over the last year, we can see that the last year has been really, really strong. Developed markets up over a third, emerging markets up 25%, the S&P 500 in the United States up 38%. What I would like to just point out is if we have a look over the longer periods of time, over 5, 10, 15 years, the 10-year numbers, for example, the only two places that really stand out there is US equities up 13%, Japanese equities up 7.8%, and they had particularly low inflation in Japan, so that makes that number look quite attractive on a real basis. But the rest of the world actually struggling quite a lot. So we think that the outlook for the coming 10 years might be a lot different to what we saw there because of valuations in different markets. So if we have a look at what happened in South Africa for those investors who are invested in rands, what we can see here, also a negative month in terms of our equity, bond and listed property markets. But again, over the last year, some really healthy returns from all three of those markets. Cash, obviously, for the month was slightly positive, but inflation over the last year a lot lower. And then in the month, the rand was still strengthening against the pound and the euro, but lost a little bit of ground against the US dollar. But again, over the last year to the end of October, was still up some 5.7% stronger than it was a year ago. Let's have a look at how our different strategies have performed, and we'll start with our global strategies. Firstly, these are our US dollar ones, and we can see over the last year some really strong absolute return. So the total return for someone invested in our growth strategy was almost 21%. Our most conservative strategy was up 13% over the last year in US dollars. What's more pleasing for us, however, is that we have seen outperformance of the peer group consistently over the longer periods of time, and our since inception number now, which is an 8-year track record, is our growth and balance strategies each up 1.1% ahead of their peers over those last 8 years. So if we have a look at our global strategies, but those designed for investors who think in sterling terms, UK pounds, we can see here these strategies, as you probably know, are not as old as our US dollar ones. They've only been running for 3 years now, just reached that anniversary. And since inception, all of them ahead of their peer groups. However, over the shorter term, some underperformance versus their peers, but still, in sterling terms, the growth strategy up almost 16% over the last year, which again is a very credible return and something investors are quite pleased with. So in South Africa, we run a few more models, and these are quite differing types, some more conservative like our income strategy compared to our flexible strategy, which is the most aggressive one. And you can see again over the last year, if we look at our more aggressive strategies like balanced, retirement growth and flexible, and our RI or recurring income growth, all of them over 20% returns over the last year, and all but flex healthily ahead of their peer groups, so very happy with that. Interestingly, if we look at the 3 and the 5 year numbers, we can see there that the more growth orientated strategies giving double-digit returns. And if you think that inflation on average, sort of just let's take it as a rule of thumb, somewhere around 5%, that means your retirement growth strategy was getting between 5.8 and 7.1% ahead of inflation per year over the last 3 and 5 years respectively. So some of those underperforming years that we saw, particularly during Jacob Zuma's presidency, have now turned, and we're starting to catch that up, which is really good to see and makes a material impact on clients' wealth. And then generally over all the longer periods of time, most of the strategies outperforming their peer groups very nicely, which again is very important for us. So there was a lot of excitement around the Government of National Unity, but the first sort of bigger challenge that they've seen has been the medium-term budget policy statement, and that was released during October, and we're going to just unpack that in a few slides now. So if we have a look at how the markets have reacted to our Government of National Unity, this is what these two graphs show us. The graph on the left just showing the rand against different currencies, the dollar, the pound and the euro, and the dark blue line showing how it's strengthened since the GNU was formed, and the light blue line just showing you how it's improved year to date. And again, here we can see that the dark blue line showing that the world has responded positively to the formation of the GNU, and the currency has strengthened between 5.5% and 6.5% since that happened. On the right, it just shows us how have markets reacted. The dark blue line being the Johannesburg Stock Exchange, the dark grey line being the global equity markets, and the light blue line being the South African bond market. And we can see again, since the GNU was formed, strong outperformance of global markets by both our South African equities and bonds, and on the right just showing a similar thing since the beginning of this year. So let's unpack the government's budget in a little bit more detail. The starting point is that 20% of the budget currently gets spent on paying interest on money that they've lent in the past. And so this government is really trying to improve that, clamp down on that. One of the ways they can get out of it is control their spending and try and grow the economy. And this graph on the left-hand side just shows how in the early 2000s, the amount that they were paying on interest as a percentage of economic growth, which is the line in here, not the bars, was actually reducing. And that was because the economy was growing and they were able to pay down their debt, and it was becoming a lower and lower percentage. However, since basically the Zuma years, we've seen that turn around and we've seen that line tick up really, really strongly. We have over the last sort of 3 years seen it flattening out. In other words, we haven't just been adding on more and more debt. So that's been a bit of a positive sign. On the right hand side, we just show how much of our debt servicing costs make up of our total revenue. And we can see again that the government is really just trying to flatten that out by reducing the debt that we've had. So that's a positive to see that it is flattening out. If we have a look at the assumptions that they've made looking forward, I think they've been quite conservative on their economic growth forecasts. And if we can see that pick up quite strongly, these graphs will look even better. So this graph just shows, the top one, the GDP growth forecast that the Treasury has included in their budget assumptions. And we can see that the browny colored, orangey colored lines were what they were thinking in February, and then the blue ones are what they are thinking now. And we can see that although 2024 the growth projections were reduced slightly, and that was because of bottlenecks in terms of logistics around Transnet and the harbours, and also because of load shedding that we had earlier in the year, although that is now past, we've got past that. We can see that they are projecting that there is some improvement in GDP growth, particularly in 2025 and 2027. And what that means then is that the budget deficit, or the shortfall that the government has, becomes a smaller percentage of our GDP growth. Having said that, we think that these percentage growth numbers in GDP could actually be too conservative. And that is actually normal. The government is usually, or the Treasury is usually more conservative. They'd rather underpromise and try and over-deliver. But if I look at what other economists are saying, these numbers could actually be a fair bit lower than what the outcome really is. One of the main things that rating agencies and foreigners look at when they look at a country is how big is their debt versus their economy. And so this slide just has a look at that. And on the left hand side, we're showing that our debt to GDP, which is the ratio they talk about, is expected to peak at around 75.5% of our GDP. And that is slightly worse than what they were predicting in the budget speech at the beginning of 2024. And that's just because revenue collections have not been, or they're not expecting them to be as good as they were originally projecting. And that's because companies have made smaller profits, and some of the challenges with logistics and load shedding in the early part of the year. But the important thing is that they are seeing that trajectory turn, and for it to continue to be reduced through time. And really just taking some of the savings that they're able to make by reducing their debt servicing costs, because interest rates are also reducing globally, and then putting that into paying down debt, which then enables them to not spend as much on debt going forward. So here we've got a slide that looks at all the credit rating agencies. And really, if you've got a good credit score, you pay less interest when you loan money, and that applies to governments as well. And here we see, going back to 2010, anything above the zero line on this graph meant you were an investment grade rated country. So big tick if you were above the solid line. And we can see that we fell below that. We fell into what they call junk status. So credit rating, or our credit score was not very good anymore. And the country has been working, or Treasury has been working hard to try and get that turned around. And we've just started in the last few reviews by these credit rating agencies they're starting to talk about improvements. And so hopefully we can start seeing that turn upwards, and this would be a further positive to the government's budget. So they'll then they're being seen as handling their fiscal management well, and if we get a higher score from the ratings agencies, that means our interest that we pay will reduce, because people will say, okay, well, I won't charge you as much interest because you're good for it. And so that's an additional improvement that we hope to see over the coming years. It's still going to take a few years, but we think that we're generally on the right track to see that turnaround happening. So not too exciting talking about budgets. I guess in summary, we're heading in the right direction. And there could still be a few surprises that could even make the outlook look even better in terms of economic growth, as long as the government continues to control spending, which it looks like they are doing. If we have a look forward to next month, because we already know that Donald Trump is the president in waiting for the new term starting in 2025, but we'll unpack that as to what that means globally for markets around the world and for economies around the world. We think on the whole it's probably positive, but we'll unpack that in a lot more detail next month. Look forward to seeing you. Bye-bye.